All right, 12 o'clock local time here, Tuesday, January 5th. Give it another 30 seconds for people to join in, and then we'll get started on this week's webinar. All right, let's do it. First webinar of the new year. My name is Derrick Smith. I'm an associated member of T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Quick position disclosure. Given 17 positions right now, 3 to the short side, the rest to the long side. We've been in a bull market, in case you didn't know. So it makes sense to have some longs on, have some long swings on. I certainly do. Some new additions, got in this FUBO yesterday. Still have some of that today. Kind of my big winner on the day. That's basically it. So let's get started here. So quickly about me. I'm senior trader and registered principal at T3 Trading Group. I've been with the firm for over a decade now. I've been a licensed individual as a professional trader here at T3 since 2011. I've mentored well in excess of 100 professional traders, currently managing a group that is well in excess of 50 traders. Personally about me, big into martial arts, big into skiing, big into traveling. I think a lot of people have been following along with this webinar every week, and you've kind of seen all the different locations that I've been traveling from. I've been trying to take advantage of this COVID situation, our office in Manhattan being shut down, to really see a lot of this great and beautiful country of the United States, and it's been awesome. So right now, still in Lake Tahoe, California, but this weekend I'm moving again. I'm going back to Idaho. I'm very excited to be back over there in the Grand Teton area. Looking forward to skiing Jackson Hole and Grand Targhee. Already got 20 days on snow this season. So, again, trying to make the most of outdoor activities and what we can actually do here with the coronavirus situation, which hopefully, as a country, we're starting to get through this coronavirus situation. But we'll see how that plays out. The market certainly doesn't seem to care when COVID spikes. It's just looking forward to the vaccine, as am I. So today I'm going to be talking about charts, markets, as we enter the new year. Maybe you can even be thinking of goals for yourself. Here's my email address. If you want to reach out to me about anything, please do so. Always happy to talk about markets, happy to talk about T3. Having a prop account with the firm, having a retail account with the firm. If any of that interests you at all, or even if you want to get a ski day in with me at Jackson Hole in a couple of weeks, reach out to me and maybe we can make that happen. So let's go to the charts. All right, starting from the big picture here, taking a look at the SPX, the S&P 500. Yesterday was absolutely a day to take notice. And today's kind of an important day in general, right? We have the election taking place in Georgia, and how that election goes will kind of determine the amount of power that Joe Biden is able to have as president of the United States. I don't think that we're going to see that result until tomorrow, but yesterday we kind of had our first big down day, probably since early September, as far as like a real big down day goes. We gapped up yesterday. We're up about a 0.5% pre-market, which has been par for the course. It seems we gap up almost every day recently. But then they sold this market very hard. We can take a look at the 5-minute chart from yesterday. This is 2 trading sessions ago. This is today thus far, and this is yesterday. So you can see they gapped us up yesterday, and they absolutely sold this market very hard. I was really telling my team, first down day, be cautious here. Don't just jump in right away and buy the dip. Though with that said, near lows, a little after 12 o'clock yesterday, my team and I were able to kind of recognize capitulation from the market and actually come in for some shorter term longs in that area. Particularly you could see it in Apple, right? Apple sold off really hard, high volume coming in really at that low, higher extension, right? So the way that I measure extension in the marketplace is where the market is trading relative to the 8 and 21 EMA. So you can see here my blue line is my 8 EMA and my red line is my 21 EMA. So I consider the space between the 8 and 21 EMA to be the general equilibrium area technically for the market. So when the market gets very extended away from those moving averages, well, that's what we would consider to be an extended market. You can have extension on different time frames. This is just 5-minute extension to the downside within the confines of a very weak day, right? We're selling off, we're trending down all day. You can see it here in Apple, you can see it in the SPYs, you can see it in the Qs as well. And then finally we get heavy capitulation here, high volume, extension, great looking candle here to come in and have some short-term longs on. And that's with Apple being basically 5 days down into yesterday, or I guess yesterday was the 5th day down. And it's into equilibrium on the daily chart. So Apple was actually extended to the upside here about 4 or 5 trading sessions ago. This price correction was more than I expected. I actually thought Apple might be a decent long in the beginning of the day yesterday, pre-market when I was doing my research. It was kind of on my radar, but you could tell very quickly that the market was breaking down and that yesterday, early on at least in the day, was not the day to come in and put those longs on. I do think that the shorting would have been difficult yesterday as well. First down day onto the short side is always tricky, and it's happening within the confines of an overall bull market. Right, we can look at the Qs, we can look at the IWM, we can look at the SPYs. Those are the 3 main indices that I tend to look at. I don't really look at the Dow very much just because it's not enough companies that comprise the Dow to, I think, make it a good general representation of the market. But you can see here the Qs, the NASDAQ, just been in this grindy uptrend recently, was looking pretty bullish going into yesterday's trading session and sold off really hard. And again, they're just blaming that on uncertainty on the Georgia election. We don't know how this is going to play out. I don't think we're going to know how it plays out until tomorrow. But what we do know is that markets hate uncertainty more than anything. So it's not surprising at all to see a down day. But look, this down day is still within the confines of a pattern of higher highs and higher lows here on the NASDAQ. Same thing with the S&P. Since the election, we have been in an uptrend, higher highs and higher lows. And all yesterday is another potential higher low. Will that change? Will this uptrend change? Someday it will, but I am not smart enough to tell you when that's going to be. And I don't really think anybody is. The general rule is that things like trends and things like momentum can last for much longer than anyone expects. And that's why, for the most part, easier trading is to be a with trend trader, especially in this recent market. If you're trying to pick tops in some of these crazy stocks that we've seen go up 100%, 200%, 400%, yeah, I know some of them had pretty big down days recently. Look at Jumai, right? This JMIA was up at $49. Now it's come all the way down to 34 just over the course of a handful of trading sessions. But trying to pick the absolute top in this, the example that I like to use for my team is JKS, right? You see a stock got a really big move. It's almost a natural inclination to want to take the opposite side of that trade. But look at what this JKS did back in September into October. We're looking at a $23 stock that in a month, basically every day here just about is a positive day. And a month later is a $91 stock. And you could look at this thing and you could say, it went from 23 to 34. Oh, it's gone up too much. It's too extended. It must be a short. And then look at this. Every bar here is green. Next thing you know, it's at 48. All right, it's more than doubled. It's extended. It must be a short. And then what happens? Huge acceleration day, continuation. Oh boy, it's at 66. It's gone up 300%. It must be too extended. It must be a short now, right? Nope. That short still didn't come in until $90. So, just looking at this, and obviously this is in hindsight, would you rather have been, even late, would you rather have been long at $34, or would you rather have been short this thing at $34 and fighting this all the way up? The obvious answer is long, right? So for the most part, what we want to do is we want to just be with the trend. That's really where the easier money is. Now, there's trends on multiple time frames. We call that time frame continuity. It's a really important layer of probability in your trading. To take a half step back, trading is about risk, reward, and probability of success. That's the magic formula to the business. If you can risk 1 to make 1 and be right more than 50% of the time, well, you're probably going to become very wealthy in the long run. With that said, most of the best traders I've ever met are actually professional losers. They are wrong more often than they are right, but their risk reward makes up for it. If you are able to risk 1 to make 5 and be right 35% of the time, well, guess what? Those numbers still are going to really work out in your favor. So for the most part, we want to be with the trend. So that's risk reward. Then the other aspect of it, though, is probability, right? And probability is much more difficult to define. Risk reward, simple math. I'm risking 30 cents because I think I can make $2. Probability, how do you define probability? It's much more difficult. And the reason why it's much more difficult is because there are so many things that affect the market at any given point in time. All of those things, those factors, we on my team, we refer to those as layers of probability. For example, one really important layer of probability is the market itself. Like I was telling my team yesterday, because we had a little bit of a bearish day yesterday, the correlation between individual equities and the market is extremely high, and that correlation actually increases in bear markets when markets go down. When markets go down, when they're really selling the market, just remember what happened back in March when coronavirus really picked up for the first time and we went into a bear market. They sell everything. Everything must go. So that is the correlation between individual equities and the market. If you are looking at any stock and the market itself is trending higher and you are looking to go long that individual stock, you're going to have a higher probability of success than if you did the opposite. If you are trying to short an individual stock with the market as a whole going up, you're going to have a lower probability of success. Now, there's a lot of other things to factor in. Maybe it's a strong market, but you are shorting a relatively weak stock in a relatively weak sector. Relative strength and relative weakness, that's another layer of probability. So that kind of negates the fact that the market is trending higher to a degree. The best trades are going to be the ones where everything is on your side. Every layer of probability is on your side. The reason why we're getting into this is because one of those layers of probability is what I call timeframe continuity. Timeframe continuity means that you are trending in the same direction on every time frame. Another great general market principle for people to remember is that larger time frames usually win when you have competing trends, meaning maybe my daily chart's in an uptrend, but my 5-minute chart is in a downtrend. Well, it can't last that way forever. Something's going to have to give on one side or the other. Either the downtrend that's on that 5-minute chart is going to continue, and eventually the daily chart's going to roll over and fail and reverse and start going down also, or the opposite. The uptrend on the daily chart is going to continue, and the downtrend on the 5-minute chart is going to reverse. And the general rule is the larger the time frame, the more powerful. So if you are looking at a daily chart uptrend and a 5-minute chart downtrend, it's fairly probable that at some point that 5-minute downtrend is going to reverse and not the daily chart downtrend reverse, if that makes sense for everybody. So let's take a look at a concrete example. Again, let's go back to Apple from yesterday. So what do I know about Apple? Well, we highlighted here, I believe, in one of our webinars, that back on December 15th, Apple had a very important technical breakout. I had been almost complaining that the big FANG names had done nothing for 3.5 months. We can look at Apple, just going sideways for about 3.5 months. We can look at Amazon, going sideways for probably even a little bit longer. Microsoft, going sideways here for months. Facebook going sideways here for months, right? All our big FANG names for the most part had gone sideways. And then Apple, Amazon, Microsoft all had beautiful technical breakouts. Facebook not so much, Google not so much, Netflix not so much. Apple went first. Apple went here on the 15th. Amazon and Microsoft actually went the next day. So Apple went first. It broke out of this long consolidation, and this was a great day. I remember, very specifically, one of my teammates in the VTF, Felipe. He's been a trader with me for a long time. He was hammering into the VTF that buying Apple 125, buying Apple 125 that day. And it was a beautiful technical breakout that day and a great trade that became the catalyst that led to a breakout and then an uptrend in Apple. So now what do I have? I have an uptrend after a long consolidation. I have a breakout and an uptrend in Apple, a pattern of higher highs and higher lows in this area. And then Apple gives a very big dip. I had highlighted to my team actually on this morning on December 29th, this goes back to understanding extension, that Apple was now too extended to add. I don't want to be adding Apple at 138 when that upper band of equilibrium, that 80 MA, is only at 131. It's too extended. Again, extension, another one of my layers of probability. If I'm buying Apple at 138 with the 80 MA down at 131, I again would have a lower probability of success on that trade. So we wanted Apple to correct. When a stock gets extended to the upside or the downside on whatever time frame, that stock, well, first of all, can always become more extended, a la JKS that we highlighted earlier. But an extended stock will eventually need to have a correction. It cannot just go up and up and up and up forever, though it can go up and up and up for much longer than most people probably expect. And there's two ways in which a market can correct, time or price. So a market that goes sideways and creates a bull flag, really all a bull flag is a bullish time correction, a bullish consolidation within the confines of an uptrend, right? So you could get a bullish time correction or a bull flag pattern builds out and then 80 MA can catch up, or you can get a price correction, which is when the stock corrects back down into that equilibrium area. And it's not unusual at all to see a 2 to 3 day price correction in an extended stock within the confines of a healthy uptrend. And when you see that, that's actually when you want to be looking for your dip buying opportunity, right? That's the dip that you want to buy. You want to buy the dip within the confines of that uptrend after its price or time corrected into the equilibrium area. You still need a signal to do it. You don't want to, and this is where you get into the more execution aspect of trading. Everything that I do as a trader starts big picture and then works its way down to the small picture. So I know Apple's too extended here to the upside of 138. It pulls back, okay, 3 down days in a row. It makes sense for me yesterday morning to be looking for a potential long in Apple. You know, maybe versus this low, 131.72, now that it's corrected back down in equilibrium. And then I want to go to my smaller time frames, 5, 15-minute chart. So here if we go to the 5-minute chart of Apple, again, this is yesterday's price action. Well, where's my signal? Nowhere. Maybe here. Maybe you try it off this tail. I don't like it because I would want more extension to the downside versus the 8 and 21 EMA. And again, multiple time frames. All of these same principles that I'm talking about, that I'm highlighting, they really apply on multiple time frames. It could be a daily chart, it could be a 5-minute chart. So the big picture tells us what we want to do. The small picture tells us how to do it. So Apple just telling us it's not right in the beginning of the day. At the same time, look what the SPYs are. The SPYs just selling off hard. You know, maybe you think gap fill, little hammer into a gap fill, non-confirming volume, but maybe, you know, with the market being boring as it's been the last couple of weeks, that could be an important spot. But once that opening low broke and we started really breaking down, get out of the way. Don't try to pick a bottom when there's no real signal to do it. And honestly, even if there is a signal, we don't want to pick bottoms, we want to pick retracements. If you're picking a bottom, you're saying, this is the spot where the market's going to reverse. Well, what was the principle that we spoke about already earlier in this webinar? Trends tend to last for much longer than anyone expects. So, if you have a trending market up or down, in this case, small time frame down, you're just putting in bids in here on the way down? No. That's a great way to lose money. At a certain point, you could look for some sort of capitulation buy setup to find a retracement back, right? And what does that mean? Well, that's what this is. So your volume increases, your rate of descent increases, and it maximizes on maximal volume and maximal extension. And all you're really looking for here is a price correction back into this equilibrium area, back into the space somewhere between the 8 and 21 EMA. That's all you want. So if you come in and buy, again, another strong member of my team, Brant, was hollering out, hey, I'm buying Apple here on the way up, not on the way down. Hey, I'm buying Apple here at around 127.50. You're out your risk on the trade because you have to have an out. It's what we call where your stop loss is going to be on every trade that you put on. Your out's that low. You got 75 cents worth of risk. And even if you just get a move back to the 8 EMA, you have $1 worth of reward. Let alone if you're able to get a move into the 21 EMA. That can give you potentially even more reward. Now you're looking at $2 of reward for your 75 cents worth of risk. It's not a fantastic risk reward, but what we also need to think about is that this downtrend is happening within the confines of what? This is where our time frame continuity comes in. The uptrend here in Apple. And this goes back to, again, what I said earlier. When you have competing trends, an uptrend on a daily chart and a downtrend on a 5 or 15-minute chart, something eventually has to win. Something eventually has to give. And it's going to tend to be the daily chart that wins, which means that eventually this 5-minute chart would reverse higher at some point. Again, do I want to be predicting a perfect reversal here? No. I recognize this capitulation. I recognize this extension. I put myself in a position for risk reward. I book some profit really quick, take my risk off the table, and then maybe I hold a smaller percentage of my position in case this 5-minute retracement higher does in fact become a reversal, which maybe it will, maybe it won't. It ended up closing and kind of breaking the downtrend, but not really fully reversing by the end of the day yesterday. Caught a nice little pop so far this morning along with the marketplace, but we'll see. Yesterday was a very damaging day for a lot of stocks and for the market. Now, it did not totally break our trend, right? Going back to the Qs, going back to the SPX. We're still in higher highs and higher lows here, but this is a candle, it's ugly, and it's on high confirming volume. We need to take note of yesterday's candle. Maybe this does become the first step in breaking this uptrend. Maybe it does. But again, while we are still in an uptrend, probability dictates that I am better off continuing to err on the side of the long side rather than the short side. That's still going to be where the easier money is. So again, today, I really want to be paying attention to yesterday's low. I want to be paying attention to how the market reacts off the open today. And guess what? It reacted really well. And I'm paying attention to this opening low today in the Qs, in the SPYs, because if that opening low breaks, well, that could then become the catalyst that leads to selling that breaks yesterday's low. And if we break yesterday's low, then we're starting to have a lot of problems with these charts. The uptrends are starting to break. You can look at these big tech names. Amazon is just barely holding on to its technical breakout that it had here in mid-December. Apple definitely looks better, but if it breaks yesterday's low, that could be the catalyst that gets this thing back below 125, and then this breakout is now a breakout failure. Microsoft, another one of our big tech names here. Microsoft also barely hanging on. Really starts getting below and closing below 215. Then this becomes another failed breakout as well. It's right back into its consolidation, and the opportunity there is gone. And I need to be patient again and kind of wait for the reset up. So, basically, I try very often in these webinars to impart lessons onto everyone who is watching. And, these are some of the principles, the core principles that I'm constantly hammering into my team of professional traders that I'm working with on a day-to-day basis. You have risk, reward, and probability of success. Risk, reward is simple math. Probability of success is much more dynamic. And what we need to be able to do is combine all of these things, all of these layers of probability, all of these different time frames. And what I'm looking for primarily is small time frame risk for daily chart reward. if you're able to come in, again, to use this Apple as an example, and get Apple here at 127.50, and it closes well for you, you're $2 in the money, that's a good swing opportunity. And then maybe this daily trend here continues. And next thing you know, you have a swing position and it's making new highs, it's getting up to 140. Now all of a sudden what started as a 75 cent risk trade, and you got stock at 127.50, next thing you know, you're like $13 in the money on that. And that is the overwhelming risk reward that we want to be able to capture from our trading. That's what I'm really looking for, what I call overwhelming risk reward. Ask me, Derrick, what's your ideal risk reward ratio? My ideal risk reward ratio is where the reward is infinite. It's unlimited. I'm with the trend. We're making all-time highs. I'm just riding it for as long as it'll take me, implementing trailing rules for reward maximization, which is another thing that I go over with my team in the training program that we have. And that's what I'm looking for. And at the end of the day, this is another thing I emphasize to my traders all the time, it's just math, right? Trading, it really is. We spend all this time, learning and studying technical analysis, and that's obviously really important. But at the end of the day, trading is just math. How much am I risking versus how much can I make, and how consistently can I do that over time, or how can I put myself in the position to consistently do that over time? And it obviously requires rules. So, we can talk about that more next week. And we can also, I talk about it with my team every day. So join the team. So let's hop into how you can potentially do that. How can you join my team? So prop trading with T3 Trading Group. T3 Trading Group is one of the largest professional proprietary trading firms in the United States. We have over 500 licensed professional accounts. We have offices on the East Coast of the country. Our headquarter office is in Manhattan. That's usually where I'm working. Right now I'm in beautiful California. Next week's webinar I'm going to be in beautiful Idaho. Everywhere in America is beautiful. Let's do it. We have remote traders spread throughout the country. Even before COVID hit, probably 60% of our traders or so were remote traders, maybe more. Now everyone's remote, utilizing our virtual trading floor, the Pro Desk. To become a professional trader with us, you would have to become licensed. There's 2 examinations that you need to pass. The first is the SIE, Security Industry Essentials. The second is the Series 57, which is the Professional Proprietary Traders Examination. You'd also have to pass a background check in order to join the company. You cannot be a convicted felon or declared bankruptcy in the last couple of years and join the firm. If licensing is not for you, T3 has retail accounts as well. The biggest advantage of T3's retail accounts is direct market access. Everybody saw the headline that hit with Robinhood a couple weeks ago. They got charged, I think, $65 million for misleading their clients because of how their orders are being sold out to HFT firms that are then front running those orders. So people think that they're trading for free. There's no such thing as free trading. Either you're paying a commission cost or your orders are being sold out. Well, T3's retail accounts, they have very low commissions for direct market access, and it's on professional software. So if any of this interests you, definitely reach out. My email will be at the end of this presentation again. For our professional traders, we have 3 different software options: Lightspeed, Sterling Trader Pro, and Wolverine. Personally, I use Lightspeed. They're all great. Sterling Trader Pro is great. Sterling Trader Pro is the software that we use for our retail traders. So if you open up a retail account with us, that's going to be the software that you're on. We can help you to understand the software, build your layout, hotkeys. Oh, by the way, professional and retail trading accounts, 4 a.m. to 8 p.m. 4 a.m. to 8 p.m. I know that most brokers aren't able to do those hours. At T3, we have equities trading, we have futures trading, we have equity options, we have options on futures. Reach out to me on any of these products and I'll speak with you about it myself, or I'll put you in touch with the right person. Training. Whether you're a new trader or you're an experienced trader, you're going to have access to a whole host of training and development for free just because you have an account with us. There's a 1-month training program that consists of a series of lectures. We do a morning meeting every day at 9 a.m. Eastern. We do an afternoon meeting every day at 10 after 4. Every afternoon meeting ends with a Q&A. Working to develop our traders is what's really important. And it's probably why I've been able to develop the group, the excellent group, that I'm getting to work with now on a day-to-day basis. You will have to fund your account. So for a prop account, we call it a capital contribution. So you contribute capital to fund your account, and what the firm does is we provide you buying power capital at 20 times your contribution for equity day trading, 8 times your contribution for overnight positions, and the way that you're compensated is through a profit split. The profit split is 90% in favor of the trader and payable on a monthly basis. So someone who deposits $50,000 to the firm, we basically start by allocating them $1 million to work with, and now you're trading. You get access to all the training and development that we talked about earlier. We'll give you access to textbook and online classes and everything else for those licensing exams if you need to take them. And for experienced traders, we're also a great place because you'll have the opportunity to work with other experienced traders. And as far as capital goes, T3 is very well capitalized. So if you're an experienced person who wants to contribute $2 million because you want access to $40 million, we can make that work. Reach out. My email address again is here. Oh, and you get all this other great stuff. You get access to my VTF room, which is normally like a $2,000 a year value, for free. You get access to my training program, which isn't even on here, that I mentioned, for free. You get access to Scott Redler for free. Scott's awesome. Chief Strategic Officer at T3 Live. I've learned a lot from him over the course of my career. You know, he's been, I think, involved in markets since the 90s. Has seen all types of markets come and go. Awesome guy. So I don't know what you're waiting for. I don't see anywhere else that you can get a package like you can get with T3, to be honest. And you know, that's my opinion. But I don't see anywhere else saying, here, open up this retail account and work with professional traders and get professional training. Or here, open up a professional account with us. You're going to get part of this excellent community, and you're going to get access to buying power that can open up entirely different strategies for your approach. So again, here's my email address. Reach out to me about anything. You want to talk charts, you want to talk T3, you want to talk skiing, you want to meet up in Jackson Hole for a great day, reach out to me. Here's my email address. Happy New Year, everyone. Make goals for yourself. 2020 was an excellent year for the firm, for T3, for our traders here. We're hoping 2021, we're expecting 2021 to be even bigger, badder. Let's go. So make goals for yourself. It's the beginning of the year, and then join T3, join my team, and let's make those goals a reality. All right. Have a great rest of your trading day, everyone.